once we inserted the data, we get a figure for the net assets of the organization, okay? And we can see that this organization has a large amount of net assets, 47.5 million, which is basically the difference between its assets, total assets, okay, which includes everything, fixed assets and financial assets, minus its debt or commitments to external parties. So if we subtract from the 48 million, the 800,000, this is the net asset. And this basically reflects what will happen if we close the organization at the end of 2000, if we had closed it at the end of 2016, assuming that we can liquidate all our financial assets and fixed assets, and also assuming that the amount of money that will be available after the liquidation of the fixed assets will be equal to the depreciated value of the assets, then we will remain with 47.5, which seems substantial, but now we have to look at we have to analyze it more closely. And the more close analysis shows us first that we have a significant part of this 47 million is in net assets or reserves that are not really ours. We have commitment to donors against these reserves. So this is the 13.6 million that is presented here. And again, I'll remind you, I'll explain it again, it's something which is unique to nonprofits. Since we get part of our income in restricted funds, and since there is a time gap, which means that we can get a donation, but we haven't spent it fully. So the difference, which is kind of surplus, okay, income minus partial expenses will result in a surplus, is reflected in our financial assets. Basically, we receive the money, so the money is in the bank, okay? But it's not really ours because there is a commitment to the donor to do something with this money. It's not free reserve that I can use for if I have financial difficulty. So the first thing that I need to do is I need to subtract this restricted from the total net assets, and I remain with the unrestricted part, which also appear here, 33.9, almost 34 million, unrestricted. Still, it seems like a large amount, $34 million for an organization with income of less than 11 million. So it seems that it has 3 times more in unrestricted assets than its income. But this is also not an accurate description because these net assets are partially or fully or maybe even beyond fully invested in fixed assets that are not liquid. Not only they are not liquid, but the possibility of their liquidation in ongoing operation is, the probability is 0, which means, just to translate it to simple terms, if I have missing funds, if I can't pay salaries to my employees, I cannot sell the chairs and the desk and the computers and the printers in order to pay salaries. First of all, because it's not so easy to sell this used equipment. But beyond that, if I will sell your chairs and desks and computers, where exactly are you going to work, although today we have people working at home, but still I need this equipment, otherwise I wouldn't keep it, okay? So we want to, if we are interested in the ongoing situation and not in the situation of final closure, the situation of final closure is not interesting, okay? Then we have to move on to the next organization. But if I want to look at the situation of ongoing operation the fixed assets are irrelevant and I have to take them out from the unrestricted net assets. And when I do that, by adding here the unrestricted for fixed assets, which is, as you can see, identical to the figure that we entered from the 990 form, from line 10C, then I can see that my unrestricted net assets for programs, which is the name that is used in accounting, or the operating reserve, which is the name that we will use since we prefer human language, more informative language, is negative. Now, what is this negative amount? What does it stand for? It stands for the difference between all our financial assets, only the financial assets without the fixed asset, minus all our obligation. Okay? So if I take all my financial assets, okay, the current assets, the cash, the other current assets, the investments, and I subtract from them my financial liabilities, and I subtract from them my commitment to donors, okay, what I receive basically is a negative number. Okay, so here we see that the operating reserve is in 2016 is negative, in spite of the fact that it seems that I have large amount of net assets, but they don't really serve me in my ongoing operation. And I think I mentioned that, so I mentioned again, the operating reserve is the measure of financial stability or vulnerability in the long term. Why in the long term? Because it looks at the current situation of our financial assets minus all our financial obligations, but these financial obligations, some of them are for the long term. You know, like if you have a loan for 10 years, then, so this is a very strict measure, but still it is the measure that shows financial stability. If we have a positive operating reserve, and we will see later on how positive it should be, but if we have a positive operating reserve, then we have a good financial situation. Okay? All right. Now we want to see another measure of financial stability, which is less restrictive, which is more aimed to the short term. Because again, the operating reserve, we take our current assets, but we subtract from them all our financial commitment all the way to the future. But we want to see another measure, which is more short term, less restrictive. It shows us what is our situation now. Let's look at this table, which basically defines a new term, which is called working capital. Short WC, but it's not the toilets. Working capital, okay? So what is working capital? Working capital, the definition of working capital is current assets minus current liabilities. Okay, that's the algebraic, the mathematical definition. What does it mean? So let's look at the definition of each one of the components. Current assets is the cash that I have, plus all my receivables. All the money that was recorded as income in this year was not received by the end of the year, but is expected to receive within the next 12 months. Usually by the time that the statements were prepared, it was already received. Current liabilities are all my expenses that relate to the current year, were not received by the end of the year, and were not paid. This is expenses. All the expenses that relate to the current year, to 2016 here in the example, were not spent. The cash didn't come out from the bank by the end of the year, but it will be spent in the next 12 months. Okay? The difference between current assets and current liabilities answer the following question. Suppose that I'm able to receive all my receivables in January 1st, and I pay all my short-term debts, all my payables in January 21st, how much I'm left with, okay? So if current assets is larger than current liabilities, it means that after receiving all my receivables, paying all my payables, there is still a positive amount at my disposal. I have enough money to pay all my short-term debts, and I will still remain with something, okay? And then working capital will be positive, okay? Current assets larger than current liabilities. The break-even is when current assets is exactly equal to current liabilities, which means that I have enough cash plus receivables to pay all my payables. And after I do that, I'm left with nothing, zero. So this is the break-even. And we have the opposite of a deficit in working capital, which means negative working capital, which means that even when I collect all my receivables plus all my cash, I do not have enough money to pay all my short-term debts. In that case, current liabilities will be larger than current assets, and I will have a deficit in my working capital. So first of all, is the definition clear? Okay. So now, yes.
Explain again current liability.
Current liabilities are all the expenses that relate to 2016, but were not paid fully by December 31st, 2016. Like invoices that are for 2016, but I only received them in February and March 2017. Salaries of employees for December that were not fully paid by the end of December, but paid at the beginning of January, okay? Other expenses related to employees like pension funds, benefits, again, for this December salary that usually are paid in a delay, a few days later. So in the bank account of December 31st, we will not see these expenses, but they are recorded as expenses for 2016, and therefore are current liabilities for 2016. Yes, Lisa.
But I always have to define the time period, right?
Yes, in the financial statements, it's very easy. It's always the calendar year. Okay, and we talk about.
When someone asks me in June, what is your working capital?
So usually you will not be able to tell that.
Okay.
So that's exactly the issue that we will discuss in this third part, how we manage to use the financial statement, which is for the past, in order to plan for the future. But it's true that all these calculations of current assets, current liabilities, they're time consuming. So usually they're not done fully during the year, but only at the end of the year. So during the year, you don't know what your working capital, but you do know what is your working capital in the past, and you can predict more or less your working capital situation at the end of the year as a base for planning for next year. Okay, so this is the limits of what we can do. By the way, working capital, as you can understand, is the measure for what we call liquidity position of the organization, which means that if we have a negative working capital, there is a significant risk that the organization will not be able to meet its short-term obligations, which is a very serious risk. And to your question, Lisa, if you have a negative working capital, how will you know it? Suddenly or not suddenly, you will find yourself without the ability to meet your liabilities, to pay to your suppliers, to pay to your employees. So we understand that we want to have positive working capital, or at least zero, break even. And if we have a negative working capital, that's not a good situation to be in. That is a situation that we need to amend, and we need to amend very fast, because it poses a significant risk of financial default in the short term, not 3 years from now, but maybe a month from now. Okay, and that is the importance of working capital. And just for you to know, working capital is the measure for liquidity or liquidity possible problems also in the business sector. When banks will look at the financial statements of organization before approving loans, they will look first of all on the working capital. Okay, so this is the working capital. We have another sub-definition which we will use in order to understand more profoundly the issue of cash flow, and that is net working capital. So what is net working capital? Net working capital is defined as the difference between receivables and payables. How much money people owe me minus how much I owe others in the short term. Okay, so receivables minus payables. Now you can see that working capital, as we defined, is current assets minus current liability. Yes, you want to ask?
I just want to make sure. If I want to calculate the working capital for 2016, every receivable and payable that relates to 2016 is relevant. Also, if I agree with the person that I'm going to pay it in June of 2017, I'm still going to put it in 2016 because it is.
Yes, because it is. Because the expense was already recorded as expense of 2017. Yes. Okay. So the working capital, as we define it, is current assets minus current liabilities. Now, current assets, as you can see from the upper row, has two components, cash and receivables. So I can write working capital as cash plus receivables minus payables. Okay, instead of writing here current assets, I use the definition of current assets, which is cash plus receivables. Okay, and now, since I have another definition, another term, which is called net working capital, which is exactly receivables minus payables, I can, instead of using this formula, I can write this formula, which connects everything and basically says that working capital is the sum of net working capital plus cash. And to try to translate it to human terms, if I look at my net working capital, okay, then it is the difference between receivables and payables, meaning that is the money that people owe me, people, organization, whatever, is enough to cover, okay, the short-term debts, what I owe to other people. If net working capital is positive, it means that after I collect everything that is owed to me and I pay everything that I owe, I will have additional amount which will be added to my cash. Mm-hmm. So my working capital will increase. Okay. Now, if payables and receivables are exactly the same, then my net working capital is zero, and it means that basically my working capital and the cash are the same. But if the net working capital is negative, meaning that I have more payables than receivable, then in order to cover the gap, in order to pay the additional funds for my debt or for my short-term debts, I will have to withdraw from my cash. Okay? And if I don't have enough cash, then the entire working capital will become negative. Okay? So this is basically the connection. So we have net working capital plus cash equals working capital. And we will see how we use this definition in our analysis. Once we understood that, we have here a table which is colored in green, and it shows us the indicators of this organization, financial position. Okay, very short table that gives us on the nutshell what is our financial position in terms of vulnerability or stability? So first we have two lines, the net working capital and the working capital. So let's see how these are calculated. So we have net working capital is, okay, let's go up a little bit, is the receivable, which is the other current assets which are not cash, minus the current liabilities, which are the payables, okay? And we can see for each one of the measures, the measure for this year, 2016, the measure for the previous year, and the change. The change reflects what happened during the year. So we have balance and flow. So this is a flow, the change in net working capital. What do we see? We see positive net working capital, but a decrease. So again, to emphasize, what does it mean net working capital? So we have other current assets, I mark it here, blah, 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 of $2.1 million. That means income that was recorded for 2016 was not yet received by the end of the year and is expected to be received until the end of the year. Okay, so these are other current assets or receivables. Then we have current liabilities. Okay, so current liabilities are only around $2,000. And again, these are expenses that were recorded as expenses of 2016, were not fully paid by the end of the year, are expected to be paid in the next 12 months. And we can see that the difference is positive, which means that when I collect everything that I'm owed and I will pay all my short-term debts, I will have additional $1.9 million added to my cash. So my working capital is the sum of net working capital and cash. And you can see that here in this formula. So this is the amount, 1.9, that will be added due to the net working capital. On top of that, I had, at the end of the year, $4.55 million in cash. So my working capital is around $6.5 million. Okay? Good situation. Even very good if you compare it to the organization with $10 million income, has 65% almost in cash, or not cash, in liquid assets, in a working capital which is more or less liquid. Okay? Now, here we have one thing though, in the working capital, it is in a very good situation, but it is slightly lower compared to last year. So the working capital is positive, is large, but it is slightly lower. There is a negative change. It decreased compared to last year, previous year. Working capital, positive, and an increase. Now we have another measure, which is related to working capital, basically points to the same direction, but adds another dimension, and that is current ratio. So what is current ratio? Let's see the formula. So what do we see here? We see here that the current ratio is the ratio between the current assets and the current liabilities. Okay? Ratio between current assets and current liabilities. So, first of all, let's try to understand what's the relationship between the working capital and current ratio. So, let's take the break-even situation. The break-even situation is that current assets are exactly equal to current liabilities. In that case, working capital will be zero, right? Now, if I look at the ratio between current assets and current liabilities, what will be that ratio if current assets are equal to current liabilities? So, zero working capital reflects current ratio, which is 1. Okay, we all understand that, right? Don't get confused. Now, if we have positive working capital, current assets are larger than current liabilities, then current ratio will be larger than 1. Okay? And the opposite, if we have negative or a deficit in our working capital, which means current assets are smaller than current liabilities, then we have a current ratio which is smaller than 1. Okay? So this is basically the relationship between them, but basically they point to the same direction. So why do I present two measures? What is the additional information that we have in the current ratio? So in order to explain that, here is an example of two organizations. One has current assets of 200,000 and current liabilities of 100,000. Working capital will be the difference, 100,000. Okay, 200 minus 100. Current ratio will be 2. Okay? Now, organization number 2, we have current assets of 1.1 million, current liabilities of 1 million. Working capital will be the same, 100,000, but current ratio will be 1.1. So what is the additional information here? In most cases, current assets and current liabilities will be connected to the size of activity, to income. So basically the current ratio kind of adjusts the working capital to the size of the organization. It basically says that 100,000 working capital is more significant for a small organization than to a large organization. Okay, so 100,000 working capital, if we compare it to current liabilities of 100, is much more significant to 100,000 working capital compared to current liabilities of 1 million. So it kind of adds another dimension, although it is not totally necessary, but still, since it is a very simple calculation, it is added here. And you can see that there is a significant increase. First of all, the working current ratio is much larger than 1, which again is reflected by the size of the working capital. But again, the size of the working capital compared to the size of the organization. Okay, so we have here a $6.5 million working capital. And we ask ourselves, is it good or bad? Is it large enough, small enough? So the current ratio gives us kind of measure how good is this working capital. The larger, the further we are from 1, then the better is the situation. And we can see that it is significantly larger than 1 in both years. There is a jump in 2016 because there is a significant decrease in the current liabilities. Okay, but the main point is that it is way larger than 1. Okay, organization with $6.5 million working capital, but with a budget or income of not 10 million, but 100 million, then we will have a current ratio which is larger than 1, but it will be like 1 point something and not 8.6 or 34. Okay? So it is kind of adjusting the working capital to the size of the organization. And the larger the working capital compared to the size, we will go further away from 1 or the other direction if it's a negative. The information that we have here is that both these values are way, way larger than 1, which means that the working capital of $6.5 million is very large. And if you look at it compared to the organization's income, okay, so we have annual income of 10.5 million, and expectedly the next year's income will be similar. Organizations don't jump. It's not a startup company that doubles its income every year. So at the beginning of 2017, we have working capital of $6.5 million in comparison to income, which would be more or less in the area of $10 to $11 million. Basically, it means that we have more than half of the year already covered by liquid assets that we already have. This is what is reflected in this figure. Okay, the fact that it is a significant amount of liquid assets compared to our activity means that we have now, if we assuming that there is delay in income at the beginning of the year, we have enough money to absorb it. Okay, that's the translation, okay, of this financial stability measure to our daily operation. What we are looking at is what will happen if there is a kind of an external shock in our income, which is the main risk for any organization, but very specifically for non-profits. Delay in payments, reduction of something that we expected. What will we be able to continue our programs, or we will have to stop the programs, dismiss staff? And the reason I'm saying that it's very crucial for non-profits, a business that sees a reduction in income in a certain product or certain service will stop selling this product and service, will move to another product and service. You know, it's not, the business wants to make money. If it is for one product or another product, it is less important. A non-profit provides social services, educational services. The goal is to provide the services. And if we have to discontinue a service, then we are not reaching our goals. So our aim here is to create a situation in which if there are kind of interferences or suddenly a COVID pandemic or the stock exchange crashes and some of my donors delay their payment, I can retain my service until I can get the money back, until I can restore my income sources. That is the purpose of financial stability, and this is what we see, that the working capital shows me basically my short-term position. I have $6.5 million as liquid assets, and that can cover, assuming that my next year's budget will be similar to this year or not significantly different, it can cover basically almost half a year without any income. Okay? All right, this is clear?
Yes.
All right, now we have the operating reserve, which is the measure for the long term. This is taken from this table, also calculated. So you can see this is the same numbers. Here we see a different story. First of all, the measure is negative. Okay? So, and this is something that is very, I could say, we can learn a lot from that we have a very, very positive situation in the short term, but a negative situation in the long term. So obviously we'll have to explain to ourselves why, where the difference comes from. But short terms, we are fine, we're great. We have enough money to cover 6 months of operation. In the long term, we have a deficit. Okay? So first of all, description of the situation, negative. This is the situation. Now the change is a decrease. We can see it here. We had at the beginning of the year a positive operating reserve, more than $1 million. And it decreased to a deficit of 907. So the decrease, which we will have to see where it came from, is $1.9 million. That is, we kind of withdrew from our long-term savings, but we withdrew more than we had. So we entered into a deficit. So here we have a decrease. And here we have the final explanation. Okay, the verbal explanation that presents the situation of the organization. So let's go over that, see that we understand it. So the short-term position is stable. The working capital is positive. Current ratio is significantly larger than 1. Okay? That is what we saw from these two first measures. However, there is the decrease in working capital from previous year. So that relates to the change. Short-term position is good, but it is slightly less good than it was last year. Okay? The long-term position is negative. Operating reserve is negative and decreased during the year. All right? So this is what we see in the long term.